There's a lot of people talking about Victoria at the moment. But what's the difference in investing in areas like Greater Melbourne or in regional areas like Ballarat, Geelong, or even Bendigo? That's exactly what we're talking about in this episode. If you're wanting to invest in Victoria, after this episode, you're going to have an understanding of both the pros and cons in great detail. Plus, stay tuned to the end of this episode because I'm going to be giving you a bonus in Victoria that's likely to perform as well. I'm Arjun Paliwal. Let's go. Firstly, when we're pointing out some of the differences in performance between regional Vic and Melbourne, you've actually just got to look at it like that. Performance. What's the actual price growth difference between the two? And I like to break things down in various intervals. So if we look at Melbourne, this is really interesting to see. The last 1 year growth rate of Melbourne is plus 0.2% in capital growth. So practically nothing. Over the last 7 years in Melbourne, prices have grown 31%. Now, that's also practically nothing if you look at what's happened across the rest of the country over the last 7 years. Then if you're looking at the last 10 years, things get a little bit better with 63.8%. So now you're looking at respectable long-term averages. But that's interesting to know, right? Because a 7-year and a 10-year having that much difference means that Melbourne only needs to underperform for 3 more years for its new 10-year average to completely halve in value. Crazy, right? So that means that Melbourne's 10-year performance is on track to be extremely low if just over the next 1, 2, or 3 years, the performance continues. Another metric that you can review performance on as well is rental yields. Now, it's not just Melbourne. The theory here is that every capital city versus regional city tends to have variance in yields, with the regional cities being higher. But the thing is, Melbourne's rental yields are about 3.42% right now, improving a lot because rents are rising quick, with regional Victoria rental yields at 4.41%. Overall, you can see that over the last 10 years, Melbourne's been okay or pretty good. Last 7, 5, and 3, it's been horrible. And rental yields, whilst improving, are okay. In comparison to the rest of the capital cities, quite poor, other than Sydney. And then if you're looking at in comparison to the regional areas of regional Vic, it's still lower as well, which will always be the case. Now, when you're looking at regional Victoria's performance with those same intervals, you see something completely different. So firstly, over the last 1 year, regional Victoria's shared similar trends to Melbourne, down about 0.9%. So much the same, pretty much nothing happening. Over the last 7 years, you see a big performance difference. Regional Victoria has more than doubled its performance than Melbourne has, with regional Victoria rising 76.9% in comparison to Melbourne's 31%. And lastly, over 10 years, regional Victoria has done 95.3% in comparison to Melbourne's 63.8%. Not only that, the rental markets also outperformed in regional Victoria. I mentioned earlier the yields were higher at 4.41 versus 3.42, so a percent difference. But also 10-year rental growth rates at 65.2% at regional Vic versus 51.4% in Melbourne. So this is where it's important to break this all down. What does it actually mean? It means that regional Victoria and Melbourne are in 2 completely different cycles. Regional Victoria has had a stellar 7 and 10 years, and in terms of Melbourne, it's only seen a good last 10 years. Nothing special, but good. And over the last 7 years and below, it's been a poor performer. So when we look at market categorization, or in other words, people call it cycle positions, Melbourne is what we call an early adopter market, meaning somewhere that hasn't been doing well for about 7 years. And if you want to look at another episode where I've talked about this factor of not doing well, there's an episode where I talk about 3 traits that are amongst boom markets. And one of those traits is inverse market growth, which means it hasn't done so well. And so Melbourne hasn't done so well over the last 7. It's a good sign for its future. Regional Victoria has. But with regional Victoria, it hasn't done well over the last year, and trends are starting to change in some regions. We call this phase a second wind. So essentially that's when a market grows well, it comes off, and there are new trends starting to be displayed that will lead it to seeing its growth phase again. So I would almost say the majority of the Melbourne markets are going to be clustered in early adopter, but then the majority of regional Vic markets are going to be put into second wind. So what you can see is over the last 10 years, your regional markets have been your pick, but then over the next 10 years, Melbourne may step back into the equation again and be a slightly better pick. But just by saying it's a slightly better pick over the 10 years doesn't mean it's achievable, because there are two other differences in these two locations. The first difference is budgets. Remember, it's easy to say on a piece of paper that, hey, I would just choose Melbourne over regional Vic or vice versa. But when you're looking at budgets in regional Vic, you might be able to make a $450,000, even up to a $750K price point work with higher volumes. But if you're looking under $700,000 as a median price in Melbourne, there are something called SA3s, which are statistical area 3s. And they're just a measurement that the census uses as a data point of geographically putting areas together. Think of them as a cluster of suburbs, or if you want to just simplify it even more, there's council areas as well, which are different in some areas, but not all too different than SA3s. So when you're looking at this, what I'm trying to say here is that in Melbourne, there are 40 SA3 regions or clusters of suburbs. And amongst those 40, there are only 8 which have about a $700K median price and lower. So there's not a huge amount of pickings. It's actually quite less in comparison to regional Vic, which offers much more options. So that's what the budget can do for you. Now, in those 8, you might also be looking at the price points, and what house they give you are two worlds apart to regional Victoria, including the land size parcel and the rental yields. So you have to look at your budgets and your affordability positions to understand the variance of the two. But that cycle position should help you understand where one is at, second wind, regional Victoria, versus where others are at, Melbourne, more early in its cycle. Now, there are markets, though, that are in a lot deeper positions of decline, because right now in both markets you can see flat performance is common amongst both. So if we're trying to now look at it going, hey Arjun, where would you avoid knowing what you know? Here's one area where you would avoid in the short term. The market of Ballarat. The market of Ballarat has a few statistics not going for it that are leading me to believe that the second wind is not ready yet in Ballarat and may not be ready there for some time. Let's walk through some of these metrics. So firstly, Ballarat is actually down 4.9% over the last 12 months. This is only equaled to the Gippsland region, which is down similarly, or the Surf Coast region of Victoria, which is down more. So it's in that top 3 of regions that haven't performed so well in regional Victoria. Another thing is the speed to selling. Days on market has continued to increase and hasn't slowed down or stabilized. So it's clear that we're actually seeing a sign of a weakening market and more weakness to come. Another thing is building approvals remain high, and you can also see that inventory levels are quite high too, meaning elevated stock levels in comparison to who's buying there. So you can see just there that even though regional Vic might be showing a second wind in some regions, that's one region where it currently isn't showing any second wind. So I told you at the start, there would be a bonus, right? That was one area in the opposite, which is not showing a second wind. Which areas in regional Victoria or Melbourne are showing some promising signs of a new cycle or a recovery showing? The first market to point out is the market of Bendigo. So what we can see is what I call stabilization. It doesn't mean that Bendigo's turned around to be a high performer or it's turned around and the trends have shot in the opposite direction. But through things like days on market, vendor discounting, inventory levels, rental vacancy, rental growth rates, we're seeing stabilization or recovery. So this means that things are improving. And so when you start a second wind cycle, it has to find stabilization first on that dropping point, and then it needs to improve again. So that's one key point. The next one is the region of Mildura. We're seeing the same things there as well. So with Mildura, we're seeing rental yields improve. We're seeing prices start to turn into positive. We're seeing inventory trend down and stabilize and at a low level. Vacancy rates remain low at 0.3 and inventory at 3.1. We're seeing rents rise, I mentioned earlier, at 7.7, but with the healthy yields at 5.13. And even if interest rates didn't decline, the affordability is still okay. With interest rates declining, the affordability jumps a lot. So these are two markets showing some pretty good signs of being second wind in terms of their cycle improving again, both in Mildura and Bendigo. Obviously, you need to see if it fits your portfolio and if there's other regions that show otherwise, but these two are just regions that are showing some healthy signs of recovery as a bit of a bonus on this episode. So there you have it, regional Vic versus Melbourne. A fair bit of differences. It's not as simple as going, it's all in the state of Victoria. Victoria's the talk at the moment. Everything's the same. You can clearly see Melbourne has not performed as well in the last 7 years in comparison to regional Victoria. Regional Victoria is likely to go through a second wind in some cities. I gave you a couple, Mildura and Bendigo. and it's not likely to go to a second wind in other cities like Ballarat anytime soon. When you're seeing Melbourne, it's in an early phase of its cycle, so when the cycle does eventually kick off, it'll really get the full roar, considering that the last 7 years have been weak, and just give it 1 to 3 more years, all of a sudden it's an extremely low 10-year growth rate. But we still need to see some change in that data points to see that Melbourne cycle emerge. Right now, it's at what we call stabilization in some areas of Melbourne, but not all. Hope that helps you in uncovering the differences between the two. If you like content like this and want to see more data and research where we unpack markets and what directions they're going and things to look out for in your portfolio building journey, click the subscribe button and like, and of course, drop me a comment with more topics you're after.